All right. Well, good afternoon, everyone. This is Scott Thompson, and we are here for our Stock Investing for Beginners webcast. And excited to be here with you today. This is going to be one of my favorite topics to talk about. I don't know if you've been in this situation before where one of the challenges that people run into when they're dealing with trying to hold on to trades longer term is just holding on longer term, holding on through those ups and downs. And so today, what I wanted to do is go over a strategy called bull flag, short-term bull flag trades with the purpose of thinking about it in the term of the longer term. If I can take some profit in the short term, then it hopefully is easier for me to stay in the trade longer term. So I have a couple of examples I want to go through today, show you how to do that, how to pick some targets, go over the market posture a little bit today, and tell you a technique that some traders might use to determine whether or not to go for that upper flag target versus like what we call a swing target. Some ideas behind that. And then also just if we have time, we'll take a look at some of our open positions, see if we need to do any management on those. But I want to give a shout out to Simone and Eva and Jay Richardson and Scott Luck and Will and everybody else that's here. Appreciate you being here with me. Cameron May is in the chat today. He and I have been working together for a long, long time, and he's great. If you haven't seen his webcast, please go see his webcast. He teaches every day and has some great webcasts, great content out there on our YouTube channel. But before we get started, let me go ahead and remind everybody that our presentation today is for educational purposes, not a recommendation or endorsement of any particular investment or investment strategy. The stocks we look at are not meant to be recommendations. We're going to be using the Paper Money software platform on Thinkorswim. There are some significant differences in how that Paper Money account acts compared to your live account. As always, we talk about stop orders. There's no guarantee that the execution of a stop order will be at or near the stop price. Be aware that all investing involves risk, including the loss of principal, and past performance is no guarantee of future results. Let's go ahead and jump right in here. I just chatted in not too long ago the script that I am using for this three grid chart. I call it long-term, intermediate term, short-term trends, three charts, and they're just set up here on the grid. And so I'll go through this. This is how I learned how to do what I call a market posture review. Really, market posture is just market trend. You can do this technique with really any stock symbol. But I'll go through it fairly quickly here with you today. You can take some notes or whatever is, the process. But it's pretty simple and it's fairly quick. So this is something that I recommend that people do at least once a week, where they're, taking a look at the market posture. If you wanted to do this with the individual sectors, you could do that as well, get an idea of what those trends are. And then when we look at the short-term trend, I'll tell you a technique that some traders will use to help them determine whether to go for the big target or the big move versus like a shorter term swing type of move. So we'll talk about that in a minute. But the script link again is in the chat. If you scroll up, you should be able to find that. But it's also in the description of this webcast, so you can load it up there as well. So when you're doing your market posture, the long-term posture, I like to look at a 3-year weekly chart. I have a 10-period exponential moving average and a 40-period exponential moving average. You'll notice that these are very similar to a 50-day on a week, right? There's 5 days in a week. 10 times 5 is 50. So these are very similar to like a 50-period moving average and a 200-period moving average if you're looking at the daily chart. But this is really simple. If the 10's above the 40, we're long-term bullish. If the 10's below the 40, we're long-term bearish. Done, end of story. And then in the transition here, usually people will give it a couple weeks, like got to be 2 weeks below or 2 weeks above before they would change from bullish to bearish or bearish to bullish. All right. So that's the long-term posture I would say is bullish. I'm going to go up here. Long-term posture, just going to write in here bullish. Then the next chart, if I arrow over, this is the intermediate chart. This one we have a 10-period exponential moving average and a 30-period simple moving average. And this is just on the daily chart. It could be 6-month daily, could be a 3-month daily. I happen to have a 6-month daily chart here. And again, these are really simple ways of analyzing any trend. But in this case, we're looking at the S&P 500. The 30 period moving average is rising. So generally, we would say our intermediate posture is bullish. If the moving average was oscillating back and forth, kind of like it was here in June, or if it was down like it was here in March, then our posture or our interpretation of the trend would be a little different. But right here, that moving average is still rising. So I would be intermediate bullish here. And I'll just put bullish on this side. And then if we jump to the third chart, now this chart has a special feature on it. You'll notice these red and green arrows. This is called the Williams fractal. It's a candle pattern. It's not a study. So you have to go over here to patterns, and then you can go and select patterns, and that's where the Williams is. If you go over here to the candlestick patterns, type in Williams fractal, and that's what places those red and green arrows on the chart. And so if you have trouble determining where the short-term highs and lows are, this is a very helpful tool. I don't think it's perfect in my opinion, but it's very, very close. So, for the short-term trend or the short-term posture, we want to see a series of higher highs and higher lows. Just that's the definition of that uptrend, or a series of lower lows and lower highs if we're bearish or we're looking for a downtrend. Any change in that pattern, so we might get a higher high like this one here, obviously higher than the one we had. And let me change my drawing tool so you can see this a little better. But right here we had a high in the trend, and compared to the previous arrow, certainly lower, right? So we were downtrending or short-term bearish through July here. And here's kind of the cool thing about short-term trend analysis. If we're back in this time frame, I know what needs to happen in order to stay short-term bearish. I have to make a lower high. If I fail, or not me, but if the chart I'm looking at fails to make a lower high in the trend, then that trend is changing. And people ask all the time, well, how do you see the trend change? This is where it starts. This is the exciting part about trend analysis, is like right now, I can see obviously this green arrow here, which wouldn't have been there on that day, but you could see obviously we're making a lower low. The trend is intact, right? As we go forward a few days, right there, I already know something is changing in the trend. Now, I don't know what it's going to do, but I know we're not downtrending anymore. This would change our short-term posture, at least in my opinion, to kind of short-term neutral, because we're not making the lower lows and lower highs anymore. So if we go back out here, you can see, we had a high, we went down, we made a little bit lower high. We have a higher low, and then a higher high, but then we're followed by a lower low. You guys see that? So we've kind of got this choppiness going on. Some people might argue that this right here was a high, but for me, we didn't close above the high of the previous day, which is one of the ways that I like to determine my highs and lows. So this for me still works. I think we had a high here. Why is that the high? Because on this candle, the 17th of August, we closed below the low of that high day. And so that's what puts that red arrow, or that makes that a high in the trend. And then until we close above the high of the low day or one of these inside days, then, we don't have our new low yet. But right now we have a high and we have a lower low, but we don't have a lower high yet. So I don't know if the stock's going to go up and make a similar high. Anything, now this is important, anything below this high, which we'll call 78.16, anything below that will be a lower high, and that'll change our posture from what I would consider neutral to bearish to just bearish. So my short-term posture right now, based on that analysis, is neutral to bearish. So let me know if you have some questions about how I did that or what I did there. And so now here's why we do this. Why take the time to take a look at our long-term, intermediate term, and short-term posture? Well, one of the things that you may have run into in your investing and trading career is that, sometimes you pick those, what I would call, larger targets, or looking for those bigger moves. And most of the time, not all the time, of course, but most of the time, when you're trading with the trend of the market, That's when the stocks tend to trend best and when you have the higher probability of hitting those higher, bigger, lower probability, let's say, type of targets. You're looking for bigger moves, right? When the market starts to change, when we fail, like a couple days ago, right here, this day right here, we knew on the 18th, that day right there, we knew that we were no longer short-term bullish. And so, as the market starts to change trend, if you've run into this before where you're looking for your uptrending stock, because we're generally trying to trade bullishly on uptrending stocks, but you may have noticed where your uptrending stocks are not quite making it to those projected targets that you were talking about or that you thought the stock may go to. Well, one of the techniques that traders use is when that short-term posture is not the same as the longer term and intermediate term posture, or if the intermediate term posture kind of goes neutral, then what traders will typically do is they'll try to go for maybe higher probability type of trades, or if they're doing directional trades, they'll go for what we call a swing type of target versus maybe a flag type of target. And so I want to go through those examples with you today of how of like number one, how to calculate where those are. Number two, maybe how to time your entry a little bit faster than, say, our green arrows that we've been using in the past, and to try to catch momentum as it moves in the direction we're trying to trade. Okay, so I want to go through at least two trade examples today. We'll see how much time we have to do that. But I'm going to come down here and I want you to write this down somewhere, or at least remember what these are, because I'm going to be asking you at least twice as we go through this, because I want you to be able to start to see what I call a bull flag setup. Now, write this down in your notes somewhere. A setup is what the stock looks like just before you get your buy signal. So if your buy signal, for example, in our two green arrow sample investing plan, that's a longer term plan, the setup for that is when the MACD is probably starting to roll up and it's not quite to that zero line, right? It looks like it's going to go green. And so we're getting ready before the buy signal happens to be able to better take action when we get the buy signal. One of the things that drove me absolutely crazy when I started investing was that I would look at my chart, oftentimes for 15, 20 minutes per chart, trying to decide what to do with it. And I didn't have a set buy signal. I didn't have, a really solid entry trigger. I didn't really know what exactly I should look for to take action. And so I felt like I was late to the dance every single time. Should have bought that yesterday. Should have bought that 3 weeks ago. That type of thing, right? So this is one of the things that it was really, really helpful for me, is to identify this setup. If you think in like real world scenario, you've been driving, right? You've driven up and you've come up to a red light and you're at the front of the line and you start kind of looking left and right just to see what that cross traffic is doing, right? And maybe you catch out of the corner of your eye that cross traffic light that was green now turns yellow. And then you start getting a little excited because hey, if that cross traffic light turns red, then my light will turn from red to green and then I can take action, right? So this is kind of like what this is. This bull flag setup has a series of steps that we look for. And so I want to come in here. We're going to take a look at DHR first. And I'm going to change my study set now to our two green arrow study, just because you guys are used to seeing that. Now, we bought DHR last week on a two green arrow, fairly recent, right? It's the second day of the buy signal. We're actually making a little bit of money on DHR, but DHR has what I would consider a classic short-term bull flag, okay? And so I want to walk through this. It had a little bit of a bounce set up over here. I'm very, very picky about my flags, okay? So I'm going to say that last time when this pulled back, it looked like a flag, but it's not a flag for me because why? Because this high, in my opinion, is similar to this one, not higher, similar. And so my setup criteria are a little bit stricter maybe than some technical traders, but I want to go through this together with you, and we're going to place a trade on DHR, and then CVX will be the other one that we do. All right. So I'm going to zoom backwards. We're going to pretend that we're here and we're doing our daily routine together. And we're looking at this now. I know most of you have been here with the two green arrows, and the two green arrows I think is a good. There's no perfect strategy, but I think the two green arrow strategy we talk about is a good longer term strategy. Not every trade is going to be profitable, no matter what strategy you're using. But for now, kind of ignore the green arrows because we're just looking at price action. All right. So we come home from work, put the kids to bed, and we notice the stock here has gone up and made a what kind of high? If I draw a line right here, let's do this together. I'm going to be asking you questions as we go, but that's my last high. What kind of high did we make here on the 19th? What kind is that? It's a higher high, right? And so if I go to my kind of bull flag checklist, I'm thinking, okay, I need a higher high. Well, let's give some definitions. When is a high a high? Do I know this is the high yet? Nope. I don't know if that's the high. I just know it's higher than my last high. Okay, now what causes this to be the high in the trend? Well, if we close below the low of the high day, then we have a high. And then I can draw like a box around that, or a little red arrow might appear, if we're looking at the fractals. But all I really know at this point is that this is a higher high. And so in the context of trying to get ready, because remember, the whole point of doing any analysis, in my opinion, is to be ready to take action when we get our signal to do so. And so the better we are at seeing this setup or this activity or whatever it is for your particular buy signal, the better you're going to be at taking action, the better you're going to be at being consistent. And I think that's important when we're investing. All right. So I know I have a higher high, but I don't know if it's the high. So again, I come home from work. I'm probably not doing anything as of yet as far as getting ready to take my trade. I have the higher high. I need three more things. Okay. So I go forward another day and I make, what kind of high is this? Well, this is another higher high, right? Now this is my high day. Let me change my screen here. We're going to change back to a little arrow so it's a little easier to see. Okay. But this is my high day. Now, I want you to look at the numbers here. If I put my cursor here on the 20th, this is just a couple days ago, that's my high day. That's my day in the trend that has the highest intraday high. What would make this the high? Well, the high would take place when and if the stock closes below the low of this new high day. Well, the low is at 208.21. All right. Now, I don't know what's going to happen tomorrow. It could go up higher again. Obviously, with the high bar or high bubble here, it probably didn't. But the point is it could go up higher, right? Next day goes up, and we actually go up higher. We close higher, but we didn't make a higher intraday high. And now we have kind of what's an interesting term here. This candle on the 21st is an inside day. The high and low of this candle on the 21st is inside the price activity of the 20th, the day before. Our high day technically is still the day before here at 2020 or 220.67. But now this is where a little bit of a nuance comes in when we're analyzing our highs and lows. Some traders would still look for a close below the low of the actual high day, this 208.21, before they said that we had a high in the trend. Other technical traders would look at this and say, well, this is an inside day. I have a higher close, and more importantly, I have a higher low in my price activity in the short term. And so if and when the stock closes below the low of this inside day, which is higher than the low of the high day, is that confusing enough yet? So, this close, if it closes below 213.46, then I would say, there's my high in the trend in this area. And then I start looking for my other components. All right. So let's go forward a day and let's see what happens tomorrow. Now, this is the 21st, last week. The next day, we get another, what kind of day is this? The high and low of this red candle is inside the high and low of the day before. So we call that an inside candle or an inside day. If, now you guys that know candle theory, if you had a body, if the red rectangle here was inside the body of the previous day, we'd call that a harami candle. And maybe Cameron can type that word in, harami. That's a Japanese candlestick term for, a potential reversal signal, right? So, but we're still looking here. We have our high day is still 220.67. We have some inside days. And what some technicians do is they'll look at the low. So you can see those lows are getting a little bit higher. The low on the red candle day here is at 213.88. The day before is 213.46. So again, some technicians would say, okay, as soon as we close below 213.88, I'm going to say, there's my high in the trend, and I'll have my higher high that I need for my part one of my bull flag setup. All right. So now let's see the next day. Okay, the next day we go down, and this is kind of again unusual because we traded below the low of those inside days, but we didn't close below. But again, these are nuances in this bull flag or short-term bull flag. Is what do we know is happening? Well, I'm getting lower highs every day. And so as those candles start to form the lower highs, I'm still looking for a close below the low of these inside days to draw my little high in the trend. That hasn't happened yet, but it does look like the stock is starting to do this next step in the bull flag, which is a 3 to 5 day pullback. Now, some people will look at the high on this day, the 21st, and say, well, that's my first pullback day because it's a little bit lower high. Some people and most people would probably wait for a red candle to appear as the start of that 3 to 5 day pullback. And so how we count this really isn't important. Okay. Now, here's the fun part, though. Eva, you're right. It is pregnant. Um, as we start to see or recognize, hey, the stock slowing down, we were looking for a higher high in the trend, a 3 to 5 day pullback. I want the stock to pull back near support. Now, what do we know? Okay, what do we know about old resistance? What does old resistance potentially become? Those of you that have gone to Cameron's Getting Started with Technical Analysis webcast from back before, or attend to Barb's technical webcast now. What is old resistance? Old resistance becomes new support sometimes, not all the time, but that's what we look for. So as we're looking for the bull flag setup, we're looking and planning on, hey, if this stock gets down near 210, I think we've got an interesting chance of getting down near, uh, support. Okay, so we're going to be looking for setup number 3. And then the most important one for me as a technical trader here on a bull flag setup is that we make a higher low. Now, where's this? Okay, and then I'm going to give you a nuance. Okay, my last low in the trend, let's go ahead and draw that one in there. My last low in this short-term trend was there. So really anything above 199.49 is going to be a higher low, and we'll have our setup. So let's go to today. And this is where we are. Now we're zoomed in pretty tight. The stocks come down about, let's say, 3 days in a row here. Now the high yesterday was at 216.77, and the high today is at 216.85. Now I'm going to give you just an example entry signal here and an example for a short-term stop. All right. So some traders will say, hey, as the momentum starts to shift, if you look at your stock as it rallies or falls, it's kind of rare that in the pullback, the stock actually trades above the high of the previous day by very much. Today, we traded above the high of that low day by about, what is that, 8 cents? And so if you're a short-term trader, what you might try to do is to catch the momentum as soon as it shifts. And so let me give you kind of a definition. The bullish bounce is defined as a close above the high of the low day. Some people might add or above the high of the inside day. Because sometimes we'll have like we found over here, we'll have some stocks that trade inside the range of the previous day, right? And so they're just looking for the best entry signal. And so on DHR, this is what I planned out here for our example. Again, not a recommendation, but I just wanted to go through this with you of number one, being able to see the setup. And then here's kind of a little mantra that we have, or that technical traders will have, is they'll say, see the setup, place the trade. Now, what does that mean? Well, see the setup, place the trade means that you're getting ready to take whatever action you have based on your buy signal. So I'm going to do a buy stop order here. You may have seen James Boyd do some of these, but a buy stop order basically says, Mr. Broker, stop, don't do anything until something happens. And so we're going to say, if the stock trades above the high of this, the low day or the high of the inside day, whichever one gives us the lower entry price, then Mr. Broker, I want you to buy that stock for me and then activate my selling orders. All right. So in this case here, the high of the low days there's at 216.77. Yes, or today's high is at 216.85. So we're just going to go 20 cents above that high. Now it's not 20 cents above the close, so we're not like right on top of the price action. This stock's going to have to go up about $1.50 to trigger our order tomorrow. But this is how I would do that trade for this short-term bull flag. My entry price, so let's write this over here. My entry, this is on DHR, again, not a recommendation, just going through a bull flag example. Entry. We're going to go 20 cents above this high. So it's going to be 216.77. All right. Now, how about a stop order? Now, in our 2 green arrow plan, we're putting our stop 1% below the 50-day moving average, which is fine for a longer term trade that doesn't really have a price target. We're just trying to take advantage of that upward movement, right? Well, how about a short-term trader? What might they do? And you may have seen Barb do a plan called an ATR plan, where they put the stop 1 ATR below the entry price. Some traders will put their stop 1% below the low of that low day. We're going to do, again, we're going to go 20 cents below the low of the low day, whichever is lowest. So in this case, our stop's going to go 20 cents below 212.24. So our stop's going to be at 212.04. All right. Now you may be thinking, Scott, you're crazy. That's too tight. Well, again, what we're trying to do is catch a bounce of momentum, a change in the momentum. So if the stock keeps falling, number one, we're not going to be in the trade, because why? Well, the stock's got to go up to trigger our order. And then if it goes up and falls down, is that possible? Yeah, it's happened to me before. You get suckered into the trade on what looks like a bounce, but at the end of the day, the stock falls down and no longer a bounce. So it can happen. But, the idea here is we're trading a change in momentum. So we have our stop and our target. Now, I'm going to give you a T1 and a T2 on a flag. So T1 is just simply the high, that high of the high before the stock started pulling back. So in this case, it's $20 or 220.67. Okay, 2267. T2, in a short-term bull flag like this one, we're going to measure from the low of the previous low up to the current high. So I'm going to take my drawing tool and go from this low to that high, and it looks like that was $21.09. Does everybody see that? It's 10% move, 21.09. So we're going to take the 21.09 and we're going to add that to the entry price. Now that's a little different. Okay, some people will take that and they'll duplicate it, and then they'll put it at the low. Nothing wrong with that. That's another method of picking a target. Some people will put it on their entry price, like, I'm going to move this up to about here. Now, why would they do that? Well, some people will look at a bull flag as a breakout trade. So there's a little downward channel forming, and so it's breaking resistance, And just like we would measure a resistance breakout trade from resistance to the target, they're doing the same thing here in the flag. And so rather than trying to draw a changing diagonal resistance line, their rule of thumb is just to add that distance to whatever the entry price is. Okay, so in this case, we're going 216.77, or sorry, okay, 97 is our entry actually, the 20 cents above that. So 216.97 plus that what we call the flag pull, 2109. And if I did my math right earlier, that should be 238.06. All right. Now here's the nuance. Here's the nuance of this trade. Because my market posture was short-term bullish to neutral, some traders might just go for the swing high. Now that's about a $4 move, not a big move in this case for sure, but they might either go for that target or they might sell half at the swing target and then go for the flag target on the other part. So I just want to show you how to place, both of those orders. And, there's a lot of different ways to do this on Thinkorswim. I'm going to put two orders in. I'm going to do one share with the swing target and one share with the T2 target. Okay, so we're just going to go right here. I'm going to right click, buy custom with stop, or actually OCO bracket. And we're going to go with one share on each of these because we're still going to try to follow our $500 total investment rule. So our entry price we said was 216.97, and that's not a limit order, it's a stop order. Now I can use stop. I'm going to make all these good till canceled. I can do stop or a stop limit. The advantage of a stop order is if it trades a little bit above 216.97, I'm going to get into the trade. If I do a stop limit, then I've got to determine how much I'm willing to pay for this. So usually, here's another technique that short-term traders will use when and if they have the opportunity. They'll just take a look at the market before it opens, and they'll just look right up here at the bid and ask price, and they'll say, okay, is that bid and ask above 216.97 or not? If it is, if it's going to be like 220, then they might either, cancel this order because it's going to gap too far above their entry price, or they could say, oh, it's going to open about 216.50. I'll just leave my buy stop order in there. And if it trades up through 216.97 during the day, then I'll be out of there. All right. So let's put a swing target T1 220.67 on that. It's going to be a limit order, good till canceled. And then our stop is going to be at 212.04. Oops, 212. And we hit confirm and send here, and this is our swing target. And then we'll set up another trade just for practice there. Again, the stop, no guarantee get it filled there, could gap below that. We're going to send this off, and we're just going to put this in our, we'll leave it in unallocated for now. We'll send that order off. All right, let's do another one there for the T2 target. Same process, right? Let's do this one faster. Right click, buy custom with OCO bracket. Okay, we're going to use our entry 216.97. Is that a limit order or a stop order? Still a stop order. Make everything good till canceled. Our T2 limit target is going to be 238.06. And our stop on this share is going to be 212.04, just like it was before. We hit confirm and send. And now we have what we call a flag target here for this one. We'll send that order off. Okay, now let me give you one other little rule here. If you are trading for the T2 target, what a number of technical traders or shorter term traders will do is once it closes above the swing high, they don't want to lose money on the trade anymore, and so they might move their original stop up to break even. Now, again, no guarantee you get filled at break even, but that's what they'll do is they'll move their stop up to, in this case, 216.97 or whatever that buy stop order trigger is. And they'll get, they'll move their stop up there so that if the stock does reverse before getting up to their T2 target, then they're going to say, nope, I don't want to lose money on this. I'm going to manage my profit now, in addition to managing my risk. Okay. All right. So, all right. I don't know if there's any questions that have come through there, but that's what we've got going on DHR. Let me give you a few to look at on your own, and then we'll just look at some open positions to review. CVX. Okay. This is for homework because I don't have time to go through all the different details here, but want to quickly go through how a short-term trader might look at this. Okay, 197, we'll call it 198. We saw that it was struggling to give above that price. It broke resistance here. This is on the 14th. We're going up. Now, the questions you want to ask yourself as you start to see a short-term higher high each day is, what's our bull flag setup? What is it? Well, higher high. I know I've got that. I just don't know if this is the high. What would cause that to be the high? A close below 203.71. Next day, nope. Now I have an intraday higher high. That lows at 204.26. What has to happen tomorrow for this to be the high in the trend? Well, it has to close below 204.26. Okay, next day, gaps up, sells off, makes an intraday higher high, doesn't close below. Now we have a higher low and a higher high. So now what has to happen tomorrow for this to be a high in the trend? Well, it has to close below 205.52. Okay, next day closes at 205.27. Bam. I have a high in the trend. I could draw my little red arrow if I had the fractals on, right? Could draw a little red arrow up here. No, this is yellow arrow, but you get the point, right? So there's my high in the trend. Okay, I have a higher high. Now what am I looking for? 3 to 5 day pullback is pretty common. Could it be more than that? Sure. But what do we want to see? I want to see the stock come down near support, and I want it to make a higher low. I know where those are already, right? My last resistance was not 197.69, and my last low in the trend's way down here at about 186. So I know what I'm looking for. I would love to see this pull back about 4 or 5 days. I would love to see it stay above, 197 and change here. And anything above 185 is going to be a higher low, right? So next day, coming down. Next day, coming down. Wow, we're very close to this low. And what could we do? Well, we can place our order here now for tomorrow if it bounces. Which entry trigger would we use? Well, this candle here, if you're a candle theorist, that's an inverted hammer. This is the lower high. So some traders would say, well, I'm going to go in if it trades above 202.06. Some people would say, well, this is the low day, so I'm going to wait for it to get above the high of the low day at 202.39. Either one's fine. You just have to decide what your buy signal is. Okay. And Lakshmi is asking, is technically a bounce, is it a trade above the high of the low day? So let's take a look at that, because this is a great comment here. The high was 202.06. If we used our same rule set, right? 202.06 plus 20 cents would be 202.26, right? If that's where my entry trigger was. Today's high is at 202.39. So yes, that would have traded above the high of the low day enough to trigger our entry. And at the end of the day, we're losing money on something that technically hasn't actually bounced because it didn't close above the high of the low day. And we say what do we say in this case here, Lakshmi? Welcome to the market. That's what we say. Yeah, we're losing money. We kind of got suckered into a bounce. It looked like it was going to bounce and then sold off, but we're in the trade. And so, in this particular case, this is interesting too. Now, I don't know what the intraday was, but if we set up that order same the way we did, that stop would have been at 199.59. We actually closed above that. So it's possible that we'd still be in that trade because it went up and then closed above the low there. But that is definitely a trade above the high of the low day. And so you have to decide. Jay Richardson, I see you putting in, to-hold versus cuh-hold. What I would recommend for kind of homework, all right, is take a look at CVX. There's one other one I want you to do on your own, Target. Target starting to pull back into that little classic flag pattern, is run the numbers on those. Decide for yourself what entry trigger you're using. Is it 20 cents above the high of the low day? Is it a percent above the high of the low day? Are you going to wait till the close, like maybe that last 30 minutes of the day before you get in? Or are you going to try to catch the momentum like these big green candles off those bounces? And all of them have pros and cons. So you just have to do about 10 to 20 paper trades, the exact entry signal each time, and then go back and evaluate whether or not that signal works for you or not. If it doesn't, then tweak a little bit and then do 10 or 20 more paper trades until you can dial in what, hey, I feel really good or really comfortable with that entry point. All right. Well, we didn't have time to go through our open positions here. Most of these are just kind of the normal red arrows that we've had before. So I don't know that we have a whole lot to do on our portfolio here, but you could go back and check those. But hopefully this was helpful for you today to go through this process. Now, again, the whole point here is if we can take a little short-term profit off a stock, that might allow us to stay in that longer-term position a little bit longer. And one of the advantages of staying in there is to be able to get those nice gains for a longer term type of trade. All right. So again, have a great day, everybody. Thanks for being here. If you haven't subscribed, if you find this stuff helpful, we'd love to have you subscribe. Click like. That's kind of like an applause for us. Oh, and I did see this before. I apologize. There is a survey in the chat. So if you take a moment to fill that out, it's just two quick questions. Love to get your feedback and what other topics or things you'd like me to cover to help you in your investing. So have a great day, everybody. Thanks.